Hello, and welcome to the MB Financial Bank Treasury Management webinar, What's New in Payments? My name is Kim Collins. I'm Assistant Vice President at MB Financial Bank and want to thank you for joining us. Let's meet our presenters. Our first speaker today is Joe Vitale, Senior Vice President and Senior Product Manager at MB Financial Bank. Joe has over 25 years of experience in the banking industry with a primary focus on treasury management product development, marketing and oversight of online commercial banking products and digital channels. He also has managed several e-commerce solutions in his career, including ACH, wire transfer, EDI, FX, and information reporting and file transfer. Welcome, Joe. Also with us today is Sylvia Rohde, Vice President and Senior Product Manager at MB Financial Bank. Sylvia has over 20 years of experience in treasury management services and is responsible for developing, marketing, and managing treasury management products and services. She has supported a full breadth of treasury management products, including online services, information reporting and cash positioning, ACH, commercial card, vault services, integrated receivables, and integrated payables. Welcome, Sylvia, and thank you both for leading this webinar. So let's jump right in. To begin, Joe will discuss digital transaction banking. This includes the future of mobile banking, APIs, DLTs, and where legacy ecosystems go from here. Next, Sylvia will discuss the future of payments, everything from the evolution of them, problems with them, traditional payment systems, and emerging payment types, including P2P networks and faster payments. There's lots of material to cover in this webinar, so let's begin. Take it away, Joe.
Thanks, Kim. I am Joe Vitale, and I'm going to go over the first part of this presentation with you. You know, one of the overarching themes of what we're going to talk about today is how everything is moving faster, it's better, and it's easier. As a kid from the 80s, this quote is ingrained in my brain: life moves pretty fast. If you don't stop and look around once in a while, you could miss it. I'm an apostle of Ferris Bueller from the famous movie. It's really what's going on in our industry right now. Everything is moving faster. We're looking for things to be better and less complex, less friction, and to make it easier for people to do business across not only treasury management and financial services, but in general in our business at large. The next generation of online and mobile banking is something that I want to talk about. Online banking has been around primarily since the very late 90s, early 2000s. So there's not a lot of new things going on in there in terms of how it works and how customers and end users are using these things. But there's a lot within online banking that has been changing as external factors as well as new products and services and technologies have come into market. And in terms of mobile banking, that's been around for just about a decade from the commercial side. So there's a lot of explosion going on in the different types of things that companies are asking for and customers and businesses are using in terms of commercial mobile banking. The next generation for online banking. Now, online banking has been around for a long time, right around the year 2000. So for most end users, it's not anything new. But there are a lot of new things going on in online banking that I'd like to cover. The first is moving away from transactional banking to a transformation journey. End users are starting to realize that it's not just about the online banking experience itself and the feature functionality within the application that matters, but all of the other components around it in terms of onboarding and using the system, customer service, implementation, and then as new products and services are added to the online banking experience, what that journey looks like, because it's a never-ending journey. It's not that you just hit it in the middle when you're trained and ready to use the system. It's all of the things around that from the treasurer perspective as they are doing the day-to-day operations in online banking. For consolidated payables and receivables, this is important because it allows end users to have one window to manage all of their collections and all of their payables in one place. So all of the payments that are coming in, whether they're coming in from the lockbox or remote deposit capture or from other parts of the bank, end users are able to see all of that in one place and make decisions, and in most cases automatically update that to their back office system and their receivable systems. From the payment side, the ability to go in and say, here's all the payments that I need to make in one place and determine what the best payment method is based upon what the payment is going to be for, whether it's for payroll or whether it's for vendor payments or taxes, all of those things that can be done in one place as opposed to going into multiple modules to make payments and then back to the collection side instead of going into multiple places to see all of that data into one place. In terms of back office integration, companies are starting to have more demands where they don't want to use manual processes. What they want to do is take data from the online banking environment and those systems and put them in to their back office systems, whether they're an accounting system or accounts payable or receivable, in a way where they can export data but also have that feed directly, so direct data files of data or payments going into the back office so that they can have automatic reconciliation, they can manage their exceptions quicker with all of those systems, because at the end of the day, the online banking system is really more of a front end. It doesn't control the company's GL, it doesn't control their accounting, so those other systems that are part and parcel to the online system are very important. Data analytics and intelligence. So back in the day, it was all about trying to get information. And then it became all about transacting off of that information. Now it's all about intelligence. What do I have? What does it mean to me? And how can I use this information to better my business and to grow my business? So end users are looking for more information. It's not enough just to know what's in my bank account. We need to understand what I can do with that information in the bank account. What is it telling me? Does it tell me at the end of the day that I'm a net borrower so that my accounts are negative and I need to fund? Does it say that I'm cash positive for the day, which means I have more money in my accounts that allow me to make investments or push that into something else to pay down debt or do other things with it? So the more data rich that end users can get into their systems, the more they can use that information to understand what it does for them, the more intelligence that they can have around their online banking process, the better they will be to be able to manage that. And fraud and cybercrime protections. No matter what happens, we're always looking at fraud and security. From the online banking perspective, there's still a lot of fraud that happens on a day-to-day basis for our customers and for people who are using these systems. We all have to understand that we all have a role to play in protecting the environment, to protect the systems, but also to make sure that there are sound business practices in place, things like dual control for payments, making sure that your environment is protected from outside and inside attacks, whether it's a disgruntled employee, whether it's malware from phishing, making sure that your emails are protected so that you're not subject to business email compromise, making sure that your data is protected so that you're not susceptible to a data breach, or depending on the devices you use, how secure those are and where you're using those. All of those things on top of social engineering is a significant issue for online banking and to protect our customers and protect data in an online banking environment. So for next generation mobile, kind of an offshoot of online, we're kind of moving it into mobile devices. One of the challenges that we have had over the years is having siloed products and services that are not ubiquitous across devices. So the example here is looking at adaptive and responsive design so that when you hit a website, no matter what device you're using, it looks the same. It acts the same. You can do like services so that it's not really obtuse to do it on your phone, but a lot easier on the desktop. So companies are looking for easier ways to do business with financial institutions, but they're also trying to do that in devices and in processes that are most conducive to them or what they're doing on that particular day. Companies might not always be in the office, so sending wire transfers or looking up account information might not just be hands on a keyboard. It might be hands on a phone, or it might be on a tablet, depending on where they are and what they're doing in that particular day. With the responsive and adaptive design, looking for streamlining the user interface, making it easier. When you have a smaller screen, it's harder to do certain tasks. So to be able to have those services available and to be able to access those quickly in a fast way to get the information that you need is kind of where that goes for those smaller screens and those other devices. As we talk about life moves pretty fast, we also want things fast. It's kind of the Veruca Salt syndrome. I want it now, not tomorrow. I want it now. Give me the golden ticket now, Daddy. So what happens is that's what people want. They want things done immediately. They want it as fast as possible and as accurate as possible. So when it comes to alerting customers that account balances might have changed or wire transfers have come in, the key is to get that information and alert and notify the end users who need to know how to do that and see that stuff as quickly as possible, because they need that to make further business decisions. It's no longer appropriate to say what happened to your account yesterday or last week. It's what's happening now and how can I use that to better my business. And back again is fraud and cybercrime. Mobile is a real big deal right now in terms of cybercrime. Mobile malware is growing at about 150% year over year, and it has been for the last couple years. End users are using phones that are not company issued. They're their own personal devices, and a lot of times they're jailbroken. People are not using the settings that were pushed onto the phone from a security perspective. We have no idea what's on these phones that people are using across the U.S. to do banking transactions and pulling things down. So because of that, and because of those phones are the primary way for companies' employees to also do social media, to text. No one actually calls on their cell phone anymore, so they're doing all these other things that might not be conducive to work that are very susceptible to malware and phishing attacks as well as cybercrime. What does all of this mean? Well, all these acronyms and words on the screen, APIs, DLT, BAS, I can tell you that's not a goat and it's not sheep. And blockchain. These are things that I want to talk about that are starting to proliferate here in the United States. A lot of these concepts that we're going to talk about for the rest of the presentation are happening across the world. Not yet so much in the United States, but we're getting there. So I want to talk about two of these that are coming our way and will be very important in the next 2 years for all the financial institutions in the U.S. APIs, Application Programming Interface. So that's the technology that allows systems to talk to each other, communicate and exchange information. When I talk about APIs, I'm talking specifically about open banking. Bank as a service, that's BaaS, B-A-A-S. Now APIs have been around since literally the mid-90s. And I'm not talking about the ones that are exchanging data between websites. I'm talking about how financial institutions and companies can interact and connect directly to send information, to send payments, and have more of a direct connection between both entities. A little different than how we see APIs work in the world traditionally today. How are APIs used? APIs can be used in many different ways. The key is that it has that same kind of workflow and connection. One of the most popular ways is to initiate payments. So instead of going into a website, logging in, teeing up templates, setting dates and sending transactions to the bank, this is a way where a company can just send that information directly to the bank, not even using file transfer protocol, but just fetching and gathering and getting information to and from each entity. Another example is getting account balances, verify balances. So today you might have to log into an online banking system. You'd have to turn on your phone and look at your balances. You might have to set up some sort of data connection. APIs will allow companies to go fetch that data and bring it right in. The benefit here is it's not likely that you want to read that. It's more likely you want to put that into another system. Ingest that into a system that's going to be calculating banking account and balances and information potentially across multiple banks, or in feeder core systems that need to get that data ultimately to understand your cash position. Another example is to confirm FX rates. So for doing international transactions, going back and forth immediately through quick interfaces, depending on the currency and the country you're in, time is of the essence. Remember, it all moves pretty fast. Same thing here. If I can get that information quickly, I can get a better rate on my cross-border payments. Some of the benefits of APIs, it's faster. It's cheaper. Remember, it all moves pretty fast. To do that process doesn't take as long as it does for you to manually log into systems and manually bring in imports and exports. If you're a file-based company or want to move to file-based, it'll have those more automated processes as opposed to, again, pulling down reports, exporting and importing data, logging into systems, which eventually would give you a tighter integration and more flexible workflow so that you can actually have more efficiencies from your back office to your front office and integrating with your financial institution. I really like this slide. This is from MuleSoft from a few years ago. Actually, now they're a Salesforce company. This gives you a really great visual of what APIs are. So think of it like a waiter. So the waiter is going to take your order at the table. They're going to relay that order back to the kitchen. The kitchen is going to fulfill that order or your meal, and then the waiter is going to bring it back to your table. That's exactly how APIs work. It's a request system where you say, I want this, it goes to get it, is this what you want, and it brings it back. Some examples of sites that you might be visiting on a daily basis or weekly basis that use this type of technology: Kayak, Expedia, Google Maps. So when you're at one site, it aggregates all of your flight information, or it aggregates all of your rental car options or your hotel options by going out to all of those other extraneous systems, bringing that in so that you can see it in one place. That's an example of how APIs are working, and that is the technology that's being leveraged for open banking and bank as a service, where banks are trying to replicate that with their customers. Distributed ledger, aka blockchain. We keep hearing about it. We don't know what it is. It sounds cool, but what is it? Well, it's basically a distributed ledger, and it facilitates the process of recording and tracking transactions across a larger network. We do sometimes associate this with cryptocurrency. It's not always associated with it. It's kind of things that are part and parcel, but we do also reference this as blockchain. So how is distributed ledger used? This is important because we're starting to see a lot of movement in the industry now, not just big companies like IBM having blockchain solutions. We're starting to see a lot of financial institutions starting to lay the groundwork and processes and strategy around blockchain. It can be used in a lot of different ways. I'll have an example in a future slide that I think will really illustrate the point, but some examples are real estate and land transfer title. So when you're doing like-kind exchanges, if it's a 1031 or if you're doing property transfer, you need some visibility around that entire process of where the property exists, how that changed hands and ownership. A lot of times you can't see any of that information. It just happens. Here's the deed, sign this, here's the keys, you own the property. Well, how can I see all of that visibly in transparency to see where all that was? More importantly, how can I see if something was wrong? If that transfer really shouldn't have happened or was transferred in error. We don't really have a way of seeing all that across a ledger. Cross-border payment transaction processing. This is another great example of seeing where the currency was purchased on the open market, how that was applied to payments, and see where those payments go through the payment flow, what systems they go through, how it gets processed, and how it gets posted to back office systems. So it's really looking across a distributed ledger that everybody has access to. Today, it just happens and you don't see it. It goes into the magical vortex. It goes into the black hole and I get paid. But this is a way for people to see and have access to every piece across that distributed ledger. Some of the benefits of distributed ledger: it expedites your settlement times. Be a little faster. Reduces your operational costs because you have accessibility to a larger distribution network across the ledger. But most importantly, it increases the visibility. It allows for transparency and be more efficient across where those transactions and where those things that occur are throughout the entire process from beginning to end. Where today you go from A to D, but you only see A and D. Here you can see all of the letters in between when it goes from A to B, B to C, and C to D. So here's an example of distributed ledger through a blockchain brought to us by Everledger. In this example, we're going to use diamonds. You can use any gem, but we're going to use this with diamonds. So one of the benefits of distributed ledger is it allows that transparency across the entire supply chain. So in this example, you can see where the diamond was sourced. You can see how the transfer of ownership happened along that entire process. So the key is seeing from point A to point D, but seeing B and C in the middle, as opposed to saying, well, I got it from here, now you can buy it. So the blockchain will allow folks to see exactly where, in this example, a diamond was sourced, how it came back, say, into the United States, how the transfer of ownership occurred, and then eventually into the hands of a jeweler, so that if a consumer was willing to buy that diamond and they had questions on where it was and was it stolen, where was it sourced? In this example, you see that you have a thief icon. Was it stolen in any place? Is it actually a legit diamond? Is it real? You see the grading, the GIA. Was it actually graded and legit? This is an example of how the blockchain could provide transparency across the entire supply chain so that all interested parties can see where it is through the process and provide that assurance to be efficient and to have the disclosure and transparency of where that diamond came from beginning to end. So just another example of where distributed ledger can benefit throughout a blockchain environment. The last thing I want to talk about is legacy ecosystem transformation. This is something that we've been seeing in our business for the last couple years, and it's starting to come to a critical mass. Just about every company I talk to, just about every bank that I see is doing something at some level with digital transformation. I'm going to go through a couple of these items to give you an idea of what we're seeing in the industry. Back office and enterprise transformation. I don't know one company right now that's not transforming some sort of legacy system. A system that's 10, 15, 20 years old that just doesn't work anymore. I just went over some stuff around APIs and distributed ledger. Those are newer technologies. They're not going to work with the old stuff. That's like me trying to, program my Commodore 64. It doesn't work. Those tape drives don't exist anymore. We need to up the ante on technology. Banks and financial institutions and companies are pouring money into new systems. We're at a point now where these systems can talk to each other a lot better than they have in the past. More efficiency. We're not going to be able to be prepared for the future if our systems are lagging and just don't get to where we need to be. The supply chain digitization. This is another example of where companies are starting to look at efficiencies. Typically back in the day, or might I say last week, companies are writing checks, attaching those to invoices, putting those in the mail, and sending them to their trading partners and their vendors. That's a very manual process. It costs a lot of money and time to process payments that way, not just from the AR side, but also from the payable side. It's both sides of the transaction. Companies are starting to deploy technology to automate that, whether it's electronic payments versus through wire ACH, whether it's e-invoicing, so electronifying the invoice process. What that does is not only allow you to get paid faster, which is the name of the game if you're a treasurer, but it also allows you to take that information and post that automatically to your receivable system, to post that automatically to your bank accounts, and eventually your back office accounting system. So this way, it happens faster. You get paid faster. On the paying side, there could be benefits for someone to pay electronically by maybe getting a discount or actually consolidating those and make it easier for them so that they don't have to issue checks and worry about check processing costs or mailing costs. So the digitization of the supply chain is happening rapidly across the U.S., and companies are starting to take advantage of the reduced costs and the efficiencies gained through that transformation. So the last item for legacy ecosystem transformation would be real-time payments and immediate payments. This is going to be a lead-in to Sylvia's part of the presentation, but the whole world is moving fast. Just like Ferris Bueller taught us, life moves pretty fast. Payments are also starting to move fast. In other parts of the world, this has been going on for many, many years. The United States is a little lagging in this area, but we're starting to catch up. We're starting to see real-time payments flow through the network. That means companies are going to have to really catch up and make sure that their systems are available, their employees are ready to adapt, and to be ready for real-time payment processing. This moves payments from settling 2 days, 3 days in the past, even a few hours, to a few seconds. So with that, I will turn this over to Sylvia, who will be talking a little bit more in detail about real-time payments and alternate payment solutions.
Thanks, Joe. While we've been talking about faster payments, I'm going to take a step backward and let's review the evolution of payments and how we got to where we are today. It may be interesting to know that paper checks go all the way back to the 9th century. Ancient Romans, Muslim traders, and even Venice merchants used paper checks. But eventually those payments needed to be transferred from people to people in cash. and that opened up a vulnerability in the system that was ripe for fraud or robbery. It wasn't until the 20th century when the Federal Reserve in 1915 began moving cash between banks electronically rather than through physical transfers. And it wasn't until 5 years after that that innovative department stores and oil companies began offering charge plates to their customers that allowed them to transact business without bringing in cash or checks. 30 years later, those developed into the credit cards that we know today that were even accepted internationally. And the evolution of payment systems continued. In the 1970s was when we began to see the ACH, or Automated Clearinghouse Network, evolve. It began as several regional clearinghouses that then merged together into a single clearinghouse. And it not only allowed the transition of funds, but also the transition of accounts payable details, which was helpful in clearing books. If you can believe it, it was another 40 years before we saw in 2016 the same day ACH payment emerge, allowing files to be settled on the same day that they were initiated. But payments are even getting faster than that. Before we go into how payments are getting faster, let's examine some of the problems that we have with payments today, starting with clearing availability. In the 1970s, it was fine for payments to only clear during Monday through Friday business hours because that's the way all of the businesses worked. But we're now in a real-time area where 24/7 by 365 is the expectation, and we need payment networks that can satisfy that demand. Settlement is another issue with payments. Payments today may not settle for 1 or even 2 business days after the receipt or initiation of the payment. Payment finality is another important aspect. When the payment is made, you want to know that those funds deposited in your account will stay in your account. Cash obviously gives the ultimate in finality, but some of our other payments can be withdrawn or returned because of insufficient funds, leading to uncertainty in forecasting. Debit payments are an important part of what we've come to understand, both as part of our ACH network and some of our other payment methods like credit and debit cards. This option makes collecting funds from your trading partners much simpler and more reliable. Accounts payable information is critical because lack of this data makes it difficult to reconcile. You may have the money, but if you don't know what invoice it applies to, that causes issues within your company. This is especially critical when you may withdraw a service if you don't get paid, like, for example, the electric or water being supplied to a house that hasn't paid their bill. And finally, how much does it cost to make the actual payment? There are a variety of costs for these payments, and the higher the cost, the less likely merchants are to want to accept that payment. Understanding the various criteria that are important in deciding which payment type to use, let's examine the traditional payments that exist today. We're going to look at checks, wire transfers, ACH payments, and debit and credit card transactions. As you can see, wire transfers have a clear advantage in terms of how quickly they settle, whether the settlement is real-time, and finally the finality of the payment. This is why when you're purchasing a house, you often sit in the title company waiting to find out that the wire transfer has finalized so that everyone knows that the buyer has been able to pay for the house from the seller. Debit and credit transactions also offer near real-time clearing, but the settlement really is only happening on a daily basis, and the payments can be reversed. If there's some issue between the merchant and the buyer can call their issuer and have that transaction canceled. And checks, while having been around since the 9th century, have all sorts of complications, including that it's a very variable rate at which they clear and settle, and after clearing, they are final, but only after the final clearing, which could take days. And finally, ACH payments. They clear multiple times per day. They take a second day to settle with the traditional ACH payment, and they can be returned for up to 60 days, making the finality very challenging. Some of the other criteria we want to consider for traditional payments are whether or not we can use debit payments, and ACH and the debit and credit transactions are the only ones that allow that. When it comes to accounts payable and accounts receivable data, the ACH network innovated with electronic data interchange, and some industries, such as automotive and healthcare, mandate this, making it easier for providers to seamlessly load their data back into their accounting systems and other systems of record. Credit and debit cards allow for this as well, because they know what type of vendor that you're doing business with due to the vendor codes that are sent with the payment. They know who the person is who's doing the transaction, which helps you understand which department they're in, and that allows you to get to general ledger level account information so that you can settle the transaction into the correct account. But when you talk about checks, all of that information has to be exchanged manually and typed manually into systems. And with wire transfers, there's only minimal detail that travels with the transaction. But as with anything, when you're thinking about which transaction to use, you also have to consider the costs. And while wire transfers has a lot to recommend them in terms of their settlement and finality, they are also the highest cost of all of the transactions. And ACH is the lowest cost, with the debit and credit, depending on the dollar amount of the transaction, can also be a high cost option. The final thing you want to consider when choosing a payment type is whether or not it is something that could be susceptible to fraud. As Joe talked about, fraud is increasingly important in the payment ecosystem. As you can see from the AFP Payments and Fraud Control Survey from 2017, check is has one of the highest rates of fraud, where the electronic payments, ACH, credit card transactions, and then wire have lower rates. All of these are things to consider when you think about which payment type to use, but none of these has the perfect solution for immediate, final settlement and low cost. Faster payments is where everyone in the world is going. 22 other countries have already adopted faster payments, and it includes some money center places like the United Kingdom and Singapore. The United Kingdom has actually been using faster payments since 2008. Singapore adopted them in 2014. But what's surprising is smaller countries such as Brazil and Mexico have also adopted faster payments. And there are 19 other countries who have faster payments in development. The United States is moving slowly. Notch just allowed same-day ACH payments for credits beginning in September of 2016 and debits beginning in September of 2017. In Q4 of 2016, there were 13 million same-day ACH payments. In 2017, that grew to 35 million payments. So as you can see, there is demand for faster payments in the U.S. But even with these same-day ACH transactions, there are some limitations in terms of how much money can be transferred. And the final step is moving to the real-time payments network. The first transaction in the U.S. real-time payment network was processed in November of 2017, but today only 6 banks have adopted real-time payments. There is a push to have all banks to have adopted this by 2020. What we in the United States want to make sure we do as we develop this network is have a unified solution that has ubiquity. Some people may remember back into the early days of ACH when all banks could not exchange ACH payments because some banks weren't set up in the network. The real-time payment network is working hard to get all U.S. banks on the system again by 2020. You also need strong fraud controls because faster to settlement also means faster to fraud. And this is a final payment method that wouldn't allow for a return like the ACH network and the credit networks. So it's very important that we understand that those are legitimate transactions moving through the network. And finally, even though it has finality, there are those instances where funds do need to get returned because of an error of some sort. That's why Monopoly has the card, bank error in your favor. The UK took 9 years to develop their method for returning funds. That's something the US network is going to have to work through before wide adoption of this becomes available to businesses and consumers. One way the US has taken a step forward in faster payments is with P2P or peer-to-peer payment networks. What are peer-to-peer payment networks? Well, they're networks that allow small dollar payments, typically via cell phone applications. It eliminates the need for cash. If you talk to millennials, you'll find that most of them don't have cash in their pockets and have never written a check, but they certainly know how to use their app to send money to their friends. And the payments can be seen immediately, so it's similar to exchanging cash. But there's one other aspect of peer-to-peer networks that is appealing, and that is that you don't need to exchange account information the way you do with the account data that's on a personal check or the account information that you exchange when doing the ACH transactions. And that is because peer-to-peer networks use something called social tokens. A social token is only an email address or a cell phone number that the user, when they register for the service, ties to their account number or sometimes to credit or debit cards. Sometimes these need to be a one-to-one relationship. Other times they can be signed up in real time at the time a payment is given. In any case, it protects the account information between the payer and the payee. So let's examine some of the P2P networks in detail. Zelle is a P2P network that's sponsored by banks. Venmo is a P2P network that's part of the PayPal universe. Google has their own version, Google Wallet, and finally Square has a version, Square Cash. This is not an exhaustive list of P2P networks. There's others, including Apple Pay, but I think within these four we can see some of the variations and what can happen here. As I said, Zelle is sponsored by banks, so the money actually is in your bank account, and it's like writing a check that's settled immediately. The funds come out of your account immediately or go into your account immediately and can be used within seconds. Transactions typically take a few minutes to finalize, so if you're sitting at the table after sharing a meal and want to divide up the cost of the meal, you can do it before you leave the restaurant. Venmo was one of the early P2P networks and is still one of the most popular, especially with the younger people. The most common transaction is splitting up pizza. And so in addition to being able to send money and some information, you can actually add emojis to your transaction as well. It does have slight cost, especially if you're using your credit card to back it up. And the funds are in the Venmo account, not immediately in your credit card or bank account, although they can be transferred. There are limits on how much can be transferred in a 30-day period. Google Wallet takes it one step further. They integrate with the Google Gmail service, and you can simply click on a $ on the toolbar to send money through Gmail. Finally, Square Cash doesn't even require that you sign up for an account. It integrates with email, and with each transaction, you can register a debit or credit card to accept or send funds between two users, exchanging only email addresses. These are very popular networks. However, if you look at the usage rates, you'll see it's mainly younger people who are using these, and over 30% of the country in the US has not even known about a P2P network, let alone used one regularly. So now that we know a little bit more about faster payments, same-day ACH, and P2P networks, let's look at these compared to each other and how they measure up against our payment criteria. Again, ACH is the only payment type that allows for debit payments, But the other networks do allow for a request for payment, which is a new concept in the industry that electronically sends that request to pay. For accounts payable and accounts receivable information, all of them have the ability to send information, but the P2P networks have a minimal ability versus the same-day ACH, still with the electronic data interchange richness of data, and real-time payments, which are introducing additional messaging types that will tie to the original payment that will include the ability to even send invoices in images. When you think about clearing, settlement, and finality, real-time payments has a clear advantage over the other methods. Although same-day ACH will settle, it settles in morning windows, and P2P networks will settle real-time, but again, withdrawing some of those funds into your actual bank account may take more time. Finally, when we look at costs, we have a variety of what the industry will be charging, but same-day ACH on average are going for about $1.50 a transaction, and real-time payments have started with some as low as $2 per transaction. P2P networks may be free for consumers, but most banks are charging businesses to use this method. So while these payments are coming faster, they are coming at a cost. These are higher costs than traditional checks and ACH payments, although very competitive against wire transfers and even debit and credit cards. And then finally, there are limits on how big the transactions can be. Same-day ACH and real-time payments top the transactions today at $25,000, although there is some talk in the industry in ACH to raise that to $100,000. And once real-time payments has tested their fraud system, they likely too will raise their transaction limits. The P2P networks vary, but these are going to be smaller transactions typically meant for consumers, so most of these top out at around $3,000 to $5,000 per transaction. So real-time payments looks very interesting. Let's take a deeper dive to see what is really available. As we said earlier, these are credit-only push transactions. The reason behind that is to try to eliminate fraud. There is, however, the request for payment messaging. This is not live in the real-time payment network yet, but we anticipate that it will be available this year. However, there is no requirement that there is an answer to this message. So even though someone sends a request for payment, there is no need for the network to answer back, and there's no expiration on those payment messages. So it is not a guaranteed way to get paid. Accounts receivable and accounts payable details can be included, and as noted before, this separate message can include images. It also supports messaging to request information about a payment that was received if you get a payment and don't know how to apply it. But these messages will come at additional cost to the underlying payment method. Clearing and settlement is the compelling reason for using the real-time payments. You get an immediate confirmation that the payment was received. It's only based on the available fund in a sender's account, so you know that those are good funds and that you won't see an insufficient fund like you might with a check or an ACH that will take those funds out of your account. And the finality is that there's real-time posting, and today doesn't allow for returns. Now, what this means is as someone sending a real-time payment, you need to make sure that you are happy with handing those funds over to your trading partner. As an example, we have seen some fraud in the P2P networks where people were buying concert tickets or other things through Craigslist, other kinds of networks such as that, and in the end found out that the tickets were fraudulent and found out that they also could not withdraw their payment because even though it was done electronically, it was done with final settlement. Finally, the great thing about the real-time payments network is that it is the first network that is a true 24/7 by 365. So whether it's 11 p.m. on a Saturday night or 11 p.m. on Christmas Day, the transaction can still go through, and you could withdraw those funds from an ATM and go use those funds elsewhere if you needed to. But again, only 6 banks are live. We are hoping that by 2020 we see ubiquity in the U.S., meaning that all banks will be able to transact this. There's a lot of exciting things happening in payment networks. The fastest innovation that we've seen in the last 50 years is happening now. But as Joe mentioned, it's important that you understand your own infrastructure and ecosystem before you jump into these payments and understand how they can support your business model and work with your systems. And now I'll turn it back over to Kim.
Thank you, Sylvia, and thank you, Joe. You both shared a wealth of information on digital transaction banking plus the potential future of payments. On behalf of Sylvia and Joe, thank you for attending the MB Financial Bank Treasury Management webinar. Should you have any questions after listening to this webinar, please contact your MB Relationship Manager or complete the form found on our website. Thank you again for attending the webinar.